Hi, I'm Stuart Jackson, Portfolio Manager at Montgomery Investment Management. Welcome to this week's Video Insight. This week I would like to discuss an important and growing segment of the financial services market, mortgage broking. Mortgage brokers provide an important distribution channel for lenders across the spectrum, from major banks to the regionals through to the non-banks and securitised lenders. Mortgage brokers provide an opportunity for smaller lenders to access a materially larger pool of potential customers on a variable cost basis, without having to incur the fixed costs invested by the majors in building their direct sales capability. This is an important service that reduces the barrier to entry into mortgage lending, increasing competition in the market and generating lower borrowing costs for consumers. That's not to say that there are no risks associated with third-party originated loans. One of the key catalysts for the GFC was the remuneration structure of third-party loan originators, which incentivised them to write loans irrespective of whether the borrower had the ability to repay the loan. We view that the view of the regulators to date has been that the benefits of increasing lender competition outweigh the risks of bad behaviour, and the fact that most loans are written and retained on balance sheet by regulated lenders means that there is more incentive for lenders to be mindful of the risks. Increasing capital requirements and risk aversion has seen the major banks become more rigid in their assessment of mortgage loans, making it more difficult for consumers that don't check all the boxes to be approved. The mortgage brokers offer access and help in applying to alternative lenders that are not as mechanical in their assessment of mortgage applications. The consumer's perspective regarding the value of brokers is reasonably clear, given that over the last 2 years, the percentage of new mortgage approvals originated by third parties, mainly mortgage brokers, has increased from 48.4% to 54.3% according to APRA data. This figure is even higher at just under 60% when non-ADI lenders are included. Broker share of originations is likely to continue to rise given decreased consumer trust in information provided by banks and increased product options in the market. The industry is broken down into two parts: brokers and aggregators. Aggregators are dealer groups that act as an intermediary between the lender and the broker, providing back office support, technology, systems and other services for brokers while providing a more consolidated grouping of applications and service with the lenders. The brokers deal directly with the customers and access lender options through the panel provided by their aggregator. Both broker and aggregator revenues are linked to the aggregate value of new mortgages settled through an upfront and trail commission structure. Therefore, the profitability of these businesses is driven by the flow of new lending, either a purchase of a property or a refinancing. Flow is more leverage exposure to changes in demand for mortgages than the exposure through the growth of a lender's loan book. The current low interest rate environment, combined with elevated levels of household savings on the back of fiscal stimulus, has seen a surge in demand for new mortgages. This is fueling strong growth in commissions for listed aggregators like AFG and B&K, as well as vertically integrated broking groups like Mortgage Choice. The other interesting development in the industry is the considerable consolidation that is occurring at present. Subject to a favourable court ruling, the two largest mortgage aggregators, AFG and Connective, plan to merge. Smaller aggregator Loan Market agreed to acquire NAB's portfolio of aggregators, making it the third largest. Aussie Home Loans, which is partly owned by CBA, agreed to merge with online broker Lendy. And now, REA has announced its bid for Mortgage Choice, combining it with its existing smart loan operation. This is likely to result in more efficient operators, providing scale for ongoing investment in systems required to meet growing compliance and automated processing requirements. The winners will be valuable gatekeepers that could develop scale barriers to entry in the market. This would provide strong earnings growth and returns for investors in coming years. That's it for this week. We'll be back next week. In the meantime, you can follow us on Facebook and Twitter.